It's old news now that the Reserve Bank held interest rates steady in July, but what's ahead? In this week's Property Insider video, Dr. Andrew Wilson gives you his views. We also talk about the latest home loan approvals, building approvals, and what's happening to rents around Australia, and a surprising result of the auction markets on the weekend. If you want to keep up to date with what's happening to our property markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you up to date each time a new show comes out. It's old news now that the Reserve Bank held interest rates steady in July. But what's ahead? Well, it's almost unanimous there's going to be at least one, maybe two more rate rises. Two-thirds of economists who are paid handsomely to predict these things are predicting a 13th rate rise in August. And the futures market has odds at 100% rise by September, 60% rise for a second one in February. So in today's Property Insider video, I'm keen to hear the thoughts of Australia's leading independent housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. I'm also interested in his monthly rent report, and we're going to talk about some clues in the news as we discuss the latest home building and loan approval statistics, as well as the weekend auction results. Hi, Andrew.
Yes, a very interesting week of activity, Michael, and we probably could say that every week, couldn't we? It certainly did start with interest rates, and I know that there's been a lot of chat out of the minutes, particularly in regard to the Reserve Bank minister saying it's been a very close decision between pushing rates up and having them on hold. And I was probably a little surprised still that they decided to hold rates over July. Of course, that's the second pause in 4 months that we've had. From my perspective, I think that if you're a Reserve Bank or in any type of economic forecasting or modelling, you have to rely on the data. And I think that if you rely on the data and you have a model that reflects the data, then at least you can blame the data in terms of if it doesn't work out as you'd hope. But I almost thought that this decision had been made prior to the data that we'd received over the month. It was as if perhaps that during the June meeting, and the minutes said that it was a very close decision between a rise and a pause, and of course they went with a rise, perhaps they decided, okay, we'll go with a rise this month and we'll have a pause for all those of you who want to pause. We'll give you your pause next month. A lot of question marks over the performance of the Reserve Bank. And as I said, I think that if you're relying on a model that reflects the data, then all you can do is engage that model according to the data. And I think there was absolutely no justification from the exposed data during June for a July pause. The logic of it all is I'm not so sure what that would do anyway if they're predicting another increase. I mean, surely you lose momentum in terms of constraining spending. And isn't that what it's all about? You want to keep putting your foot on the brake, not put it back on, well, perhaps not the accelerator, but certainly you're taking the foot off the brake, which is what's happened over July, which can only act in a sense as a quasi-stimulus to the economy, people being relieved that they don't have another interest rate increase. We've seen some very strong results, which we'll get to at the end of this show in terms of the auction market at the weekend. I'm not quite sure what the logic is if we're trying to quell inflation, which is way too high, underlying inflation, that we would have a pause to sort of wait and see what's happening and then be saying, well, but next month we're going to put it up. So how long do we wait and see?
Well, the data you're talking about, Andrew, I guess includes unemployment, which is near record lows, jobs growth that we're creating, and retail sales still rising, Andrew.
For me, as I said, there was no data that was released over June, and of course that was mainly May data, that substantiated any sense that interest rates were having an effect. In fact, it was still going the opposite way. In other words, the data was showing us a strengthening economy rather than a weakening economy, or rather than just an economy that was marking time. I don't think interest rates have had the slightest impact on underlying inflation over the last 12 months or more since we've entered the increase cycle. The reduction in inflation has basically been all about fuel costs, which have halved over the past year. And that's the story really in other economies. The inflation improvement has really been about falling price of oil rather than tackling underlying inflation And the conundrum is that perhaps those higher interest rates have activated wage demands in what is a very tight labour market, not just in Australia, but also US and most other advanced economies. And that means that that's worked its way into higher services costs, which is what we're seeing. And the Reserve Bank has acknowledged that that's a big problem at the moment, that we're seeing services costs accelerate to the highest levels since around 2000, which of course was fueled by the introduction of the GST. But okay, it's good news. Let's not quibble. We're talking about this from I guess, a theoretical point of view. And from the point of view of mortgage holders, though, this is good news because they don't have another rise to worry about and another stimulus for the housing market.
But I guess what's happened, Andrew, is the burden of reducing interest rates is now being carried by a small percentage of the community, and they're suffering. I mean, this cycle of rate hikes seems to me more than ever to be worsening the inequality. During the pandemic, there's been lots of people who've built up savings, lots of people whose houses have gone up in value, people who have little or no mortgage. And then there's those who bought a house over the last couple of years, borrowed at very low interest rates, and they've got very little savings and a big mortgage. And they're the ones who seem to be suffering more.
Yes, but at the end of the day, it's a very strong labour market, Michael. So there is the capacity there to improve your balance sheet on the income side because there is plenty of work around and wages are rising at the fastest rate in over 10 years. So yes, I understand it. And these are tough times for some in regard to higher interest rates, but at least we have that offset of a very strong labour market and surging wages at the moment. So, of course, that doesn't quarantine everybody from the pain, but there's no doubt that the signs in our economy in terms of activity are certainly robust still. I mean, retail sales, as you mentioned, up again. The housing market's very strong. I'm not sure where the data's coming from that the Reserve Bank refers to. It continues to refer to consumer spending being reduced. Now, the retail sales data was a little flat to start the year, but from a very, very high base. And now it's picked up again, retail spending over May. As I said, I think we can only, have confidence in the Reserve Bank if it's following the data that we can see, rather than referring, as it has done at times, to these sort of in-house data sets, particularly in referring to wages. It was always referring to its insights from sort of connections in the business community that were telling it that wages were rising quickly, but in fact they weren't, and they were consistently wrong in regard to that. So as I said, that's my sort of call on the decision to pause, and yet now we're saying we're going to pause, but hey, that doesn't mean anything because we're going to start to increase rates again. Surely that's taking 2 steps back and 1 step forward in terms of trying to tackle inflation. And the drums will be beating if we can't we've still got underlying inflation at around about 6.5%, Michael. And the target is 2 to 3%. We are light years away from that. We have these issues with services costs. Wages are still rising. Productivity is not reflecting those wage rises, and that's only going to fuel or continue to keep underlying inflation well above the target range. And maybe we're going to have a different looking Reserve Bank sooner rather than later, but nonetheless, they've got a responsibility to, at least if they're going to be, whatever their current jurisdiction is, be tackling the problem, which can be around now terribly for a significant period of time, and that is inflation.
So, Andrew, one of the other factors leading to inflation, driving inflation and rising rents. But over the month of June, there seemed to be a slight pause in that and just a little bit of relief for tenants.
Yes, Michael, it was an interesting result. Of course, we've been used to month-on-month chant of rents surging, and that's been really the case for the best part of a year. Even though, rents were still rising generally over June, it was a little bit more mixed. And I think the key point was we really saw an increase in vacancy rates, Michael. Now, let's be clear. Vacancy rates are still low, but there was all capital cities reported an increase in vacancy rates over June compared to May, with the exception of Darwin, which was flat. Now, as I said, they're still very low, so it's not a lot of relief, but I do think it does reflect the holiday period in June. Of course, we had the King's birthday. And we do see that, Michael, when we do have holiday periods, and we saw that in April, that it does affect the vacancy rate. Of course, this is logical because tenants and landlords are a distracted holiday period. So we tend to have less engagement in our rental markets, as we do in our sales markets as well. And I think that had some effect on rents as well. Most capitals still were reporting higher house rents over the month. Brisbane house rents, however, eased by 5.7%, and Hobart was down 1.8%. Sydney was flat, which is the first relief for Sydney for a while, but still that very high rent of $750. And our early data is showing that that's not going to last too long in terms of relief for Sydney house tenants. Yeah, so just some better news, if you can say that, Michael. I'm not sure it's great news. Some better news, but I do think it reflects those holiday distractions that we had over June. And we can look at the annual data, and it's still very strong there. A similar position in units, Michael, unit rents over the month, although not the same relief. We saw only Canberra and Perth where rents didn't increase over the month, and we had some strong increases. Melbourne continues to surge. Its unit rents up 6.8%. There's I think we're seeing the effects of migration now on the Melbourne unit market, particularly from students. So Melbourne unit rents up 6.8%, Sydney up again 3.4% for unit rents after some easing the month before. And you can see those big increases, or we've had very significant increases over the past year in Sydney, Melbourne, and Brisbane in unit rents. And vacancy rates were higher for all capital city units over June compared to May, again reflecting those holiday distractions, and all vacancy rates. In fact, the highest vacancy rate that we have for units is 1.4% in Hobart and Canberra, and that's a very, very low rate, and yet that's the highest rate that we have of the capital. So yeah, look, perhaps slight relief for house tenants, Michael, over June, but I do think that it's a seasonal impact, and that we'll be back to, for houses anyway, higher rents again over July. And it's, remains a very significant challenge to be able to house our populace, particularly in our rental markets.
Well, that's one of the reasons we keep track of building approvals. And we know that even though buildings and many of the big towers that get approved don't actually come out of the ground because currently they're not financially viable, it still gives us an indication of what's ahead. And the latest housing building approvals rose a little bit, but particularly with units. But that's a much more volatile market, isn't it? One or two big towers can make a big difference to building approvals.
Yeah, absolutely, Michael, you're spot on there. And we had a bit of a surprise at building approvals that have been falling consistently for some time now. For houses, for homes, were up by 20.6% over May, a very big rise. And we saw units up by 59.4%. But firstly, let's say that unit approvals have been tracking at under 4,000 a month for the capital cities, Michael, and that's a very, very low number. We have to go back more than a decade to see those sort of numbers. So units were up 59.4%, but from a low base, but nonetheless, they were up. Houses were flat, around up by 0.9%. But when we look a little closer at the data, Michael, we can see that the increase was really one significant development in Sydney that was approved over the month. In fact, there was over 3,000 units in that particular development that was approved. So it is, as you said, that sort of lumpy data set that apartments can have. But look, good news, good to see big development coming through, more supply, but we need a lot more of it, I think, in any sense, be able to address the chronic shortage of accommodation that we had. And of course, as you absolutely mentioned, even if you get your approval, it doesn't mean it's going to get out of the ground, because you have to be able to, if you're the builder developer, you have to be able to make a profit and be financially positive. That's a big task at the moment, with building costs still rising quite strongly annually. And it's building approvals, are not the whole story now, Michael, because it's also building costs. And but when we look at the annual data, it's still significantly depressed, and the long-term trend reveals that fall that we've had really since way back in 2015, when the market peaked.
What this means, of course, is that there's no end in sight to the shortage of dwellings in both the housing markets for sale and also the rental markets. When we look at home loans, we like to see what's happening ahead, because people get their loan approvals and go ahead and buy property. And so home loans bounced back a little bit over the month of May, Andrew.
Yes, look, actually, it was quite a robust result for May, Michael. When we look at the trend for home loans, it's certainly following, as we would expect, what's happening with house prices. There's no doubt that the cycle bottomed in February, which is where the house price cycle bottomed. But I think that, again, when we look at this ABS data for home loans, it was a bit of a surprise that we had a fall previous month, which was April. And of course, this is seasonally adjusted data. But the market's bounced back quite strongly. I think that, and as we've discussed, we need to really question the accuracy of the seasonal adjustment model that the ABS is using at the moment. It has been confounded, I believe, by the ups and downs of lockdown during COVID, which changed, typically strong months into weak months and weak months into strong months. And it'll take some time for the normal seasonal pattern to re-emerge. So I do think that we're seeing a little bit of volatility in that seasonal adjustment model. In other words, it's a little bit too low in some months and it's a little bit too high in other months. I think maybe May was a little bit too high, and April was a little bit too low. But there's no doubt that the underlying trend for home loans is following what we're seeing in house prices or home prices, and it has been rising since February this year. And I think the other thing we have to understand also is that with house prices down, people are borrowing smaller amounts. So that tends to underestimate the actual, because we're looking at the value of housing loans here. This underestimates the revival in home lending in terms of numbers versus actual values. But irrespective, it's just another correlating measure that confirms a revival in our housing markets, Michael. And it would have been quite unusual if we were seeing strong prices growth emerging, which we are seeing, and yet we weren't seeing higher levels of home lending, but we are seeing it. So that's validating all that we're seeing in that housing market revival.
I just wanted to interrupt this week's Property Insider chat to remind you this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat with you to help you take advantage of the new property cycle. If you think about it, an opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and your options? Remember, we've got no properties for sale, but we offer strategic advice to give you directions, results, and certainty. This is the right time to get all your ducks in a row and get set for the opportunities that are going to abound. But be careful. Property investment is a process. It's not an event. So you can't just go off and buy any property and hope to be successful. Formulating a plan and getting the right advice is more critical than ever now. So why not have a chat with the team at Metropole? Go to metropole.com.au. A while ago, you mentioned about the auction results. You hinted that they did well this weekend. And despite the holiday distractions and a lot of people having other things on their mind, there still was quite some depth and good results this weekend, Andrew.
Absolutely, Michael. A bit of a shock. I mean, we've seen what we expected was a little bit of that winter hiatus emerging over previous weekends. And a lot of those that have been the negative Nellies about the housing market were starting to say, oh, see, I told you so, and ignoring the fact that it was just typically the school holiday distractions and the winter market emerging. But Michael, gee whiz, the market's bounced back strongly at the weekend. I really had to have almost a double take to look at the data in terms of the numbers. But all double checked, and it certainly was a very strong results following two more modest weekends to start the winter season. But and of course, we still are in school holidays, but there was almost an across-the-board surge in auction results, particularly in terms of clearance rates, but also auction numbers were higher as well, Michael. So maybe it's just a short-term pause for winter this season. And I do think it sort of reflects that underlying strength of the market. But the data was almost a shock. We had Sydney back up nearly 80% clearance rate, Michael, 77.4%, well ahead of the 62.5% it recorded the weekend before. There was also 100 extra auctions, 467 auctions, which was still a little bit lower than the same time last year, but certainly buyers are quite happy to capture just about every property that is offered for sale under the hammer. Melbourne also had 100 extra auctions. Its clearance rates also picked up, and Melbourne's been steady around about 70% despite the last couple of weekends, 72.8% for Melbourne. Brisbane also picked up higher auction numbers and a higher clearance rate above 60%. Adelaide back to an 80% plus clearance rate, Michael, again with higher auction numbers. And Canberra had a strong clearance rate, one of its strongest clearance rates for some time, 72.2%, and well ahead of the 51.9% recorded the weekend before, and from higher listing numbers as well. So, it's interesting, Michael, that the winter season might be very short this year. And again, it reflects perhaps that fear of missing out energy, perhaps the migration surge now activating housing markets, particularly at the more value orientated end of the price spectrum. Yeah, we're still seeing, when we look at the results in our auction markets over July so far, and of course that's only 2 weekends, they're well ahead of where they were in all capitals, or mostly in all capitals, compared to the same period last year. But of course we were suffering from a lot of negativity because interest rates had been consistently increasing. So we're going to watch and wait with bated breath, Michael, for the results from this weekend's auction markets. Will we maintain the rage, or will we go back to winter?
Our sense is that buyer confidence is there. There's no doubt that the pause in interest rates has just given them that little bit of
Yes.
an extra spring in their step, but they're taking it into their stride. They realise that there may be another 1 or 2 interest rate rises, but FOMO seems to be creeping in a little bit. Nothing like what it was during the boom a couple of years ago,
Yes.
but people are saying, hey, I want to move on, but there isn't much stock. That's
Yes,
actually
yes.
one of the challenges we're finding, that
Yeah, I
people
think so.
aren't sure whether they should buy first or sell first
Yes.
in this challenging market.
Well, I think buying first makes sense because obviously it's a seller's market, Michael. So
Yeah.
securing property in the first instance is probably your best bet. Of course, it depends on individual circumstances, but because likely you're not going to have that much more difficulty finding a buyer for your property as you will finding a property to purchase. And that's what a seller's market is all about. And these clearance rates are clearly, even in winter, are reflecting still a seller's market, even though, look, let's be clear, a lot of the market is still not engaged, particularly the higher price ranges. They're all on holidays and they'll be in snooze mode until September likely. So, but it just shows you, as I said, that there's still surprisingly strong appetite for property given the time of the year.
Well, it'll be interesting to see next weekend's auction results, and we'll be back next week to discuss them. Thanks, Andrew.
Yeah, thanks, Michael.